$5,019.69. That's exactly where gold is sitting right now as I'm recording this on March 15th, 2026, down 1.54% in a single session. And I need you to understand something before you panic and do something you'll regret. Because here's the thing that Wall Street analysts and the mainstream financial media are burying in the footnotes. On the exact same day that price is dropping, the People's Bank of China just confirmed they bought gold for the 16th consecutive month in a row. 16 months straight, buying at prices above $5,000 an ounce. Think about that for a second. The largest foreign exchange reserve holder on planet Earth is accumulating gold like there's a closing time sale, and yet here we are watching the price drop nearly 2% today. These two facts cannot both be innocent. One of them is a setup. And by the time we're done today, you're going to understand exactly what kind of setup it is, why the PBOC isn't scared of this dip, and, most importantly, what this divergence between Eastern accumulation and Western paper selling means for every single person watching this video. Let me lay out exactly what happened this week so we're all working from the same factual foundation, because I am not going to ask you to trust my opinion. I'm going to show you the documented numbers and let you draw your own conclusions. Gold opened this week around $5,119 per ounce. By Tuesday, March 12th, it had surged to nearly $5,240. That's according to data tracked by Kitco and confirmed by USA Gold. Then sellers came in hard. Within 48 hours, gold was back below $5,100. And this morning, March 15th, spot gold hit a low of $5,019.69, down from yesterday's close. That's a weekly loss of roughly $82 per ounce, and a decline from the Tuesday peak of more than $200. Roughly a 4% swing from high to low in just 4 trading sessions. Now here's what the mainstream story is telling you about why that happened. They're pointing at the US dollar. The dollar index surged roughly 1% over the past 5 trading days, posting what Reuters described as its best weekly performance since October 2024. When the dollar gets stronger, gold, which is priced in dollars, mechanically becomes more expensive for buyers using euros, yen, yuan, and every other currency. That reduces demand, and prices fall. Simple, right? And there's a second factor: inflation fears from surging oil prices. The Middle East conflict that escalated at the end of February sent crude oil higher, and that's making the Federal Reserve's job harder. When oil spikes, inflation fears rise, and suddenly traders start pricing in, the Fed can't cut rates anytime soon, which supports the dollar further and weighs on gold. Here's what makes this particularly fascinating right now. The Federal Reserve's next policy meeting is literally in 2 days, on March 17th and 18th. According to CME FedWatch tool data, as of this weekend, 95.6% of market participants expect the Fed to hold rates steady at 3.50 to 3.75%. Not cut, hold. And that expectation of rates staying elevated longer is a direct headwind for gold in the short term. Because gold pays you nothing. It earns no interest, no dividend. So when you can park money in a treasury bill earning 3.5%, the opportunity cost of holding gold feels real. That logic is ironclad in the short term. I understand it completely. And it's exactly the logic that sophisticated institutional buyers are exploiting. I want you to stick with me here because this next part is what changes everything. Before I go deeper into the mechanics of what's happening, let me give you a quick message for those who haven't subscribed yet. My analytics show roughly 3 out of 4 people watching this video right now are not subscribed. If this kind of detailed, data-driven analysis is cutting through the noise for you today, if it's giving you clarity instead of confusion, hit that subscribe button. It takes 2 seconds. It tells me who the committed community is, it helps me keep creating this kind of content, and it helps the algorithm show it to more people who genuinely need it. Okay, back to the PBOC. Because here's where the story gets genuinely alarming, and I'm using that word carefully. The People's Bank of China reported on March 7th that their gold holdings rose to 74.22 million fine troy ounces at the end of February 2026. That's up from 74.19 million in January. Now, 30,000 troy ounces might sound small when you're comparing it to a pool of 74 million, but this is the 16th consecutive monthly increase. They started this current buying cycle in November 2024, and they have not stopped once. Not when gold hit $4,000. Not when it hit 4,500. Not when it broke 5,000. Not when it surged to nearly 5,600 in a speculative frenzy in January, its then record high. And not now, when a 1.54% daily drop might tempt a lesser buyer to wait for a better entry. According to Bloomberg, the total purchases since November 2024 in this current cycle alone amount to approximately 1.35 million ounces. That's 42 metric tons of gold, acquired systematically, month after month after month. And here's the number that should genuinely make you pause. The World Gold Council's February 2026 report confirmed that the value of China's gold reserves stood at $387.59 billion at the end of February. That's up from $369.58 billion in January. Nearly $18 billion in reserve value gain in a single month. And critically, that increase is not just from buying more ounces. It's largely from the price appreciation of gold itself. China is sitting on a mountain of gold whose value is climbing even as they add to it. Their gold reserves now represent 9.6% of their total reserve assets. Now I want to build a framework here because what China is doing did not happen in a vacuum. This is part of a pattern that has played out 3 times in modern history, and once you see it, you genuinely cannot unsee it. The pattern is this: when a dominant reserve currency begins to show structural weakness, when the debt load becomes unsustainable, when geopolitical rivals start questioning the currency's reliability, when domestic fiscal policy spirals beyond any reasonable corrective path, the smart money quietly, methodically, patiently moves into gold. Not all at once, because that would spike the price and attract attention. Slowly, month after month. It happened in the late 1960s when France, yes, France, under Charles de Gaulle, started converting its dollar reserves into physical gold. De Gaulle was famously quoted in 1965, calling the dollar's reserve status an exorbitant privilege and demanding gold in exchange for French dollar holdings. Other nations followed. The U.S. gold window was slammed shut by Nixon in 1971, and within a decade, gold went from $35 an ounce to $850. Anyone holding gold through that transition, despite all the short-term volatility, made a generational return. It happened again in the late 1990s and early 2000s, when central banks across Asia quietly began rebuilding gold reserves after the devastation of the 1997-98 Asian financial crisis. They watched their currencies get demolished while holding dollar-denominated assets, and they concluded, correctly, that they needed something outside the dollar system as a foundation. Gold started rising in 2001 from around $250 and didn't stop until it reached $1,900 in 2011. And it is happening now. The third iteration of this exact same pattern. The U.S. national debt has reached $38 trillion. That number is confirmed in reporting by Al Jazeera from early February 2026, and it hasn't shrunk since. The U.S. dollar index has been in a broad, multi-year downtrend, except for short-term geopolitical bounces like the one we're seeing right now. And the de-dollarization conversation, which was considered fringe thinking 5 years ago, is now happening in the boardrooms of central banks across the emerging world. China's chief macro analyst at Orient Gold and Credit Rating International, Wang Qing, told China Daily in January that, and I'm paraphrasing directly from his official statement, increasing gold holdings remains a long-term strategic direction for China's central bank, driven by the need to improve the structure of international reserves and steadily advance the internationalization of the yuan. That is not speculation. That is an official analyst at a Chinese state-linked rating agency explaining Beijing's strategy in plain language. Chief economist Wen Bin at China Minsheng Bank said in the same China Daily report that intensifying geopolitical conflicts and major power rivalry have further weakened market confidence in the U.S. dollar's creditworthiness, and that central banks worldwide are optimizing their reserve structures by adding gold. These are not bloggers or YouTubers making predictions. These are the official voices of China's financial establishment explaining, out loud, exactly what they're doing and why. Now here's where it gets interesting. Because China is not alone, not even close. The World Gold Council published data through October 2025, showing that central bank gold demand totaled 53 tons in that single month, a 36% month-over-month increase. For the full year 2025, central bank gold purchases ran well above the pre-2022 historical average of 400 to 500 tons annually. The National Bank of Poland led all buyers with 83 tons year-to-date through October 2025. Kazakhstan added 41 tons. Turkey, Indonesia, Uzbekistan, the Czech Republic, Ghana, the Philippines, the list keeps going. These are not coordinated in any formal sense. There's no committee meeting where central bank governors pass around a memo saying, "Buy gold now." But they are all responding to the same underlying signal. The dollar system, as the exclusive foundation of global reserves, is being quietly hedged against. And here's the part that really matters for today's price drop. The World Gold Council also confirmed that global physically backed gold ETFs posted their strongest month ever in January 2026. 18.7 billion US dollars of inflows in a single month. That is a record. More money flowed into gold ETFs in January 2026 than in any single month in the history of the gold ETF market. Led by North America and Asia, these are ordinary investors, pension funds, institutions, allocating money into gold-backed paper instruments because they want exposure to the metal. So let me ask you something. If central banks are buying every single month for 16 straight months, if ETF inflows just broke all-time records, if the fundamental case for gold has never been stronger by practically any measure, then what exactly caused this week's sell-off? This is where I need you to really pay attention, because this is the smoking gun at the center of what's happening today. According to analysis published by goldsilver.com on March 14th, just yesterday, the gold price drop this week was not a fundamental repricing of gold's value. It was, in their words, a liquidity event in a leveraged market. Here's what that means in plain English. There are two gold markets that run simultaneously. The first is the physical market, actual metal, vaults, coins, bars, central bank reserves. That market has been tightening for years. Supply is constrained, demand is at record levels, premiums over spot for physical delivery have been elevated. The second market is the paper market. Futures contracts, options, derivatives, leveraged positions on electronic exchanges. This market is roughly 100 times the size of the physical market in terms of daily transaction volume. And when something sharp happens in the macro environment, like an oil shock or a dollar spike, paper traders who are leveraged get margin calls. They need cash, now. And the fastest way to raise cash in a crisis is to sell your most liquid assets. Gold futures are extremely liquid, so they get sold, hard and fast. Not because anyone thinks gold is a bad investment, because someone needs to pay a margin call by end of business today. That is exactly what happened this week. According to reporting tracked by USA Gold, gold initially spiked from 5,296 to 5,423 on news of the escalating Iran situation. Because gold is supposed to be a safe haven, and conflict creates safe haven demand. Then it reversed violently, down more than 6% from the intraday high in a matter of hours. Paper traders flushing leveraged positions. Nothing more fundamental than that. Goldsilver.com's analysis from yesterday was explicit. Meanwhile, physical gold premiums stayed elevated. Demand from stackers, jewelers, and institutional buyers held steady. The physical market, where actual metal changes hands, told a completely different story than the futures screen. And here's the crucial point that ties everything together. JP Morgan's 2026 gold price target is $6,300 per ounce. Deutsche Bank sees $6,000. Morgan Stanley's bull case is $5,700. ANZ Research forecasts gold reaching $5,800 in the second quarter of this year. That's Q2 2026, which starts in a few weeks. These targets were all set before the latest Iran escalation. According to reporting from the street this week, Morgan Stanley analysts specifically characterized gold's recent weakness as tactical rather than structural, meaning short-term noise inside a long-term uptrend. And as reported by goldsilver.com, Goldman Sachs' scenarios tie gold specifically to oil dynamics. If the Hormuz conflict produces even a one-month partial closure, their model shows gold rising 5 to 8%. A full closure scenario? 12 to 18% above current levels. Let me slow down here and show you the disconnect I mentioned earlier in the clearest possible terms, because this is where things get genuinely surreal. On one side, the paper gold price today is $5,019, down 1.54%. That number is set primarily by futures traders on the COMEX in New York, many of them operating on leverage, many of them using algorithmic trading programs that respond to dollar index movements in milliseconds. A massive number of these contracts, the overwhelming majority, will never result in actual gold delivery. They are settled in cash. They represent a promise of gold, not gold itself. On the other side, the Shanghai Gold Exchange, where China's physical demand is reflected, saw 126 tons of gold withdrawn in January 2026 alone, per the World Gold Council. That's actual metal, physically leaving vaults. Chinese gold ETFs added the equivalent of 38 tons in January, the strongest start to any year ever recorded. The PBOC holds 74.22 million troy ounces of actual physical gold in its vaults. And India, the world's second largest gold consumer, saw 24-carat retail prices hold at the equivalent of roughly $1,000 per gram, reflecting sticky physical demand even as international prices pulled back. The paper market says sell, the physical market says accumulate. These two markets price the same underlying commodity. One of them has to be wrong. And historically, every single time they've diverged this significantly, it's been the paper market that corrected upward to meet physical reality, not the other way around. Now I want to show you the macro context that makes this week's drop look almost comically mistimed when you zoom out even slightly. Core producer prices in the U.S. rose 0.8% in January, the strongest monthly increase since mid-2025, according to Light Finance's analysis of February data. That strengthened the dollar and pushed market expectations for the first Fed rate cut out to July. According to CME Group data, the probability of a March rate cut stands at just 4.4%. So yes, the dollar is strong right now, and that mechanically pressures gold denominated in dollars. I understand that completely. But here's what that analysis ignores. The Federal Reserve Chair Jerome Powell's term expires in May 2026. That is less than 2 months away. According to reporting by Investing News Network from January 28th, Trump is expected any day to announce a replacement. Multiple analyses, including the 2026 gold outlook from State Street Investment Management, suggest the incoming chair may be more dovish and more willing to cut rates quickly in response to economic weakness. If that happens, the dollar weakens, real yields fall, and gold's fundamental support gets even stronger. That succession uncertainty is already baked into the long-term bullish case. David Einhorn of Greenlight Capital, the investor who famously shorted Lehman Brothers months before its collapse, told CNBC on February 11th that he expects the Fed to cut rates substantially more than 2 times in 2026. He owns gold. He owns SOFR futures. He's positioning for exactly what I'm describing. And here's the piece of this puzzle that nobody's quite connecting on camera right now. The University of Zurich published a landmark study by Professor Thorsten Hens, confirmed by USA Gold in their March 11th report, showing that a portfolio of 85% equities, combined with 15% precious metals, allocated roughly 2/3 to gold and 1/3 to silver, delivers higher long-term returns than a pure equity portfolio. Higher, even after accounting for taxes and inflation, based on data going back to 1972 across both Swiss franc and US dollar perspectives. This isn't a gold blog saying gold is good. This is an academic institution with 50-plus years of data saying that the conventional wisdom about gold being a dead portfolio asset is factually wrong. That study got published right in the middle of the biggest gold correction of 2026 so far. The timing of that landing almost feels deliberate. Now let me be completely transparent with you about something, because you deserve to hear both sides of this story. I am not a licensed financial advisor. Nothing in this video is personal financial advice. These are my analyses of publicly available data, and I could be wrong. There are legitimate bears on gold right now. Citi Research has a 0 to 3 month price target of just $5,000, basically flat. They're concerned that the current level is already pricing in a lot of the good news. And if the Fed somehow navigates a soft landing, if oil prices stabilize, if the Middle East tensions de-escalate, you could see gold pull back further before resuming its longer-term trend. That risk is real, and you need to factor it in. But here's what I want you to make of all this on a personal, practical level, because data is only useful if you know what to do with it. First, understand what today's drop actually is. A 1.54% intraday decline in gold, from roughly 5,100 to 5,019, is not a trend reversal. Gold ran from around $3,000 to over $5,000 in approximately 12 months. A 1 to 2% daily move inside a bull market of that magnitude is noise. According to the World Gold Council's own market commentary from last week, the $5,000 level is functioning as a strong psychological and technical support floor. Dip buyers emerged specifically at that level this week, providing a cushion that prevented a deeper sell-off. As their report noted, buyers used this zone to build or add to positions. The key line to watch, as analysts from goldsilver.com stated clearly, is whether gold closes below 5,000 on a sustained basis. We're not there. We're at 5,019. Second, understand what the FOMC meeting on March 17th and 18th actually means for your positioning. The market has already priced in a hold at 3.50 to 3.75%. That's the 95.6% consensus. Which means if the Fed does nothing and says nothing surprising, there's almost no additional negative catalyst for gold from this meeting. But if Powell signals any dovish lean in his press conference, any hint that the next move is down, That immediately softens the dollar and provides a tailwind for gold. The asymmetric risk from this meeting tilts in gold's favor, not against it. Third, watch China's next move. The next monthly PBOC gold reserve data will drop in early April 2026. If they report a 17th consecutive monthly purchase, which their publicly stated long-term strategic rationale strongly suggests they will, that's another data point in a sequence that has now been running uninterrupted for nearly a year and a half. Each month they buy, they confirm that the world's most sophisticated and patient state-level accumulator sees value at these prices. When the People's Bank of China buys gold for 17 straight months across a price range from under $4,000 to over $5,000, they are communicating something. The question is whether you're listening. Fourth, understand the oil-gold dynamic for the weeks ahead. The Middle East conflict that has driven oil higher is simultaneously creating the short-term headwind for gold via dollar strength and inflation fears. But Goldman Sachs' scenario analysis, as reported across multiple outlets this week, shows that if the Hormuz conflict escalates to even a partial supply disruption, the inflationary shock that follows eventually feeds directly into gold demand. Oil is both gold's short-term headwind and its medium-term accelerant. The current dollar rally from geopolitical fear is, according to the World Gold Council's March commentary, likely to be short-lived. Their exact framing. The dollar bounce, boosted by the current conflict, is likely short-lived, and a resumption in the downtrend should be supportive for gold. Fifth, know the targets from institutions that have skin in the game. JP Morgan is not a conspiracy theorist. They are a $4 trillion bank with research divisions that exist to be accurate. Their 2026 gold target is $6,300 per ounce. From today's $5,019, that represents a gain of approximately 25%. Deutsche Bank says $6,000. UBS says $6,200. ANZ says $5,800 by Q2. These are not bloggers. These are institutions whose clients allocate tens of billions of dollars based on these calls, and they are all pointing in the same direction. Sixth, if you've been watching gold from the sidelines waiting for the right time to buy, understand this. Flush events like what we're seeing today have historically been better entry points than watching prices run away from you. I am not telling you to buy. I am not a financial advisor, and this is not a recommendation. But I am telling you that informed people who have studied this market carefully, from the World Gold Council to Morgan Stanley to Greenlight Capital's David Einhorn, are not running from gold at $5,019. They're paying attention. Seventh, watch the Fed chair succession carefully. Powell's term ends in May 2026. The successor has not been named as of this recording. Any announcement that suggests a more accommodative replacement will hit the dollar and benefit gold nearly immediately. This is a catalyst on a 60-day clock with significant uncertainty attached. Let me bring this full circle, because I want to leave you with the clearest possible picture of what's actually happening. This morning, gold dropped to $5,019.69, down 1.54%. A completely rational person, looking at that number in isolation, might conclude something is wrong with gold. The dollar is strong, oil inflation is messing with rate cut expectations, leveraged futures traders are flushing positions, and the price is falling. That's the surface-level story. But the same morning that price flashed on screens, the People's Bank of China was sitting on 74.22 million troy ounces of gold. After buying for 16 consecutive months, after adding 42 metric tons in this current buying cycle alone, after confirming their reserve value climbed to $387.59 billion US dollars. The same morning, every major bank with serious research behind its projections, JP Morgan, Deutsche Bank, Goldman Sachs, UBS, ANZ, had price targets between $5,800 and $6,300 per ounce. The same morning, physical gold premiums remained elevated, and actual metal continued changing hands at prices that showed genuine demand. The same morning, the Federal Reserve was 48 hours from a meeting where the conversation was not, should we hike, but when do we eventually cut? The 1970s investors who watched gold get hammered during the dollar spikes in 1975 and 1976, right before it ran from $100 to $850, lived through this exact emotional experience. The noise said sell, the signal said accumulate. Most people could not tell the difference between the two. The ones who could, and acted accordingly, experienced a generational wealth event. I'm not saying that scenario repeats exactly. History doesn't work that way. The variables are different, the scale is different, the global financial architecture is different. But the underlying dynamic, a reserve currency under structural pressure, central banks quietly rebuilding hard asset reserves, paper markets temporarily diverging from physical reality, that dynamic is the same. And right now it is playing out in real time, today, on March 15th, 2026, with a 1.54% drop that the PBOC doesn't seem even slightly worried about. The only question that matters, is whether you understand the difference between a dip inside a bull market and the end of a trend. Today's data, from every credible source I've cited, points to the former, not the latter. Drop a comment below and tell me this. Are you buying this dip, holding what you have, or waiting for more clarity before making a move? I genuinely want to know where the community is positioned right now. I read every single comment, and your perspective shapes what I dig into next. If you want me to do a deep dive specifically on the Fed meeting this week and its direct implications for gold going into Q2, let me know down below. If this analysis gave you clarity today on a complicated and genuinely important story, subscribe if you haven't already, and I'll see you in the next video, where we break down exactly what the Fed's dot plot on Wednesday could mean for gold's trajectory through summer 2026. That one's going to be important. Don't miss it.